All right, today we're going to tackle a really fascinating financial puzzle. It's about a company whose individual parts seem to be worth way more than its stock price. So, let's dig in, piece together the evidence, and see if we can solve the Aimco arbitrage.
So right off the bat, here's the central mystery. The source material makes a super clear case that the real estate assets inside this company, Aimco, are worth over $7 a share. But right now, the market is letting you buy that same share for just $6. How is that even possible? Where did that $1.17 go?
And here is our first huge clue. A $3 per share cash payout is coming, and it's coming within the next 90 days. Think about that. You buy the stock for $6, and you get half of that money back almost immediately. This one fact completely changes the game. But to really get why, we've got to look at the problem this company used to have.
For years, Aimco was stuck with a classic Wall Street problem, something called the conglomerate discount. It's basically a penalty the market puts on complicated companies, and it's the real reason for the mispricing we're looking at today.
So what is this conglomerate discount thing anyway? Well, it's pretty simple. When a company gets too messy, with a weird mix of different assets, investors just get confused. They can't figure out how to value it easily. So they just slap a penalty on the stock. They often treat valuable things like raw land or buildings under construction as if they're worth nothing, just because they aren't generating cash right this second.
And this slide just lays it out perfectly. On the right, you've got a simple real estate company, a REIT. It owns apartments, it collects rent, super easy to understand and value. But the old Aimco, over on the left, that was a jumble of everything. Brand new buildings, empty plots of land, weird loans. The market hates that kind of complexity, and it punished the stock for it big time.
So how do you fix a problem like that? Well, the company's board made a game-changing decision. They decided to stop being a complicated, messy company and instead just pivot to a simple liquidation, sell everything off. This single move is what unlocked this whole opportunity we're talking about.
The source calls this decision the Rosetta Stone, and honestly, that is the perfect way to put it. It completely changed how you value the company. Instead of trying to guess future earnings, the job just became adding up the sale prices of the individual assets. All of a sudden, the whole thing went from a confusing story to a simple math problem.
And wow, did they move fast. The plan gets announced in November, and by late December, bam, a cascade of deals gets confirmed. A huge sale in Miami closes, and then out of nowhere, a surprise filing reveals even more sales. This quick succession of events just erased all the doubt and locked in the company's value in just a matter of weeks.
That big pivot unlocked a flood of deals to give us hard, cold evidence of the company's real value. So, where is that $3 cash distribution actually coming from? All right, let's follow the money.
It all starts with this number, a massive $1.1 billion. In December of 2025, Aimco signed deals to sell off a handful of its properties for that much. And this isn't some forecast, okay? We're talking signed, sealed, delivered contracts. The money is on its way. And here's where that money came from. The lion's share, a whopping $520 million, came from selling a massive property in Miami, another $455 million from a portfolio in Chicago, and then a final $155 million from some properties in Florida and Tennessee. You add it all up and you've got yourself a giant pile of cash.
Okay, so that $1.1 billion, that's the sticker price, right? They still had to use some of that cash to pay off the mortgages tied to those specific buildings. But after they did that, there was a huge amount of net cash left over, totally free and clear, just sitting there, ready to be sent right out to shareholders.
And that pile of pure leftover cash comes out to about $445 million. This is the money that's about to fuel that giant payout we've been talking about. This is the catalyst. And here it is, the big number. This is where it all clicks. You take that $445 million in cash, you divide it by all the shares out there, and what do you get? Approximately $3 per share. This is the cash that is set to hit investors' accounts in the first quarter of 2026.
And this, right here, this brings us to the real aha moment of this whole story. Because the most interesting part isn't just getting that cash payout, it's what you're left owning after the cash is in your pocket. The whole investment idea really boils down to this super simple three-step math. Step 1, you buy the stock today for around $6. Step 2, in the next couple of months, you get that $3 in cash back, which means, and this is step 3, your new cost, your rear cost for everything that's left in the company is now just $3. So that's the big question, right?
what are you actually getting for that leftover $3? Is it just a bunch of scraps and unwanted junk? Well, not even close.
For that $3 implied cost, you get to own what the source literally calls the company's crown jewels. We're talking brand new, top-of-the-line buildings in Washington, D.C., valuable land in booming parts of Florida like Fort Lauderdale and Miami, luxury homes in California, even a new hotel, and a loan that's paying a crazy 18% interest. The argument is this collection of stuff is worth way, way more than $3 a share. Okay, let's pull this all together. There's this term in investing called an asymmetric bet. It just means a situation where your potential reward is way, way bigger than your potential risk. And that is exactly what the source material is arguing Aimco has become. This chart really lays it out. The base case, the most likely outcome, values the company at $7.17 a share. But look over at the bear case, the worst case scenario. Even then, the analysis shows the value is still around $6.38. And since you can buy the stock for about $6, your downside is basically covered. That's what investors call a margin of safety, while your upside is pretty substantial.
And look, this isn't just some number they pulled out of thin air. They actually show their work. You can see it right here. They add up the cash, the value of those remaining trophy assets, the land, and then they subtract all the company's debt. And using some pretty conservative numbers, boom, you land right at that $7.17 base case value.
So what's the big takeaway here? The argument is that the huge cash payout and those signed sales deals create a solid floor under the stock price. It's a situation where, like the old saying goes, heads you win, tails you don't lose much. And that's pretty much the definition of a great investment opportunity.
And I'm going to leave you with what might just be the most powerful sentence in the entire analysis. Quote, "The sub-$6 outcome has been removed from the probability distribution." What that means is, thanks to those confirmed sales, the worst-case scenarios are now mathematically off the table. The only question left seems to be not if the value will be realized, but just how much more than $6 it's going to be.